Most people think owning some gold or silver automatically means they're protected, that just having exposure puts them on the safe side of what's coming. But history shows that's not how monetary transitions work, because in every major financial shift, the people who thought they were prepared were often the ones who were underprepared. Not because they owned the wrong assets, but because they owned too little, owned them incorrectly, or misunderstood what those assets were actually supposed to do when the system came under real stress. As we move toward 2026, that distinction is becoming critical because the environment we are entering is not a normal economic slowdown. It is a structural transition involving debt, currencies, liquidity, and trust. And in that kind of environment, vague exposure is not the same thing as real protection. The reason this conversation matters now, not in hindsight, is because positioning for safety is something that must be done before stress becomes obvious, not after. And by the time the majority of people feel unsafe, the opportunity to position properly is already gone. This is why the question is not whether gold and silver matter in 2026, but how much is actually enough to make a difference. Because there is a massive gap between owning metals symbolically and owning them functionally, and that gap is where most people get caught off guard. To understand what enough even means, we first need to be clear about what gold and silver are protecting you from, because they are not magic assets. They do not prevent volatility, and they do not eliminate risk. What they do is protect purchasing power across monetary disruptions, policy mistakes, and confidence shocks. They act as monetary insurance, not growth engines. And insurance only works if it is sized correctly relative to the risk it is meant to offset. The risk profile heading into 2026 is unlike the typical recession narrative most people are familiar with. This is not just about GDP slowing or unemployment ticking up. The core issue is debt saturation combined with political pressure on monetary policy. Governments are carrying debt loads that cannot be serviced without either sustained inflation or financial repression. Central banks are trapped between protecting currencies and protecting markets. And history shows that when forced to choose, they protect markets first. The choice has consequences for savers. When real yields are suppressed, when currency purchasing power is diluted, and when financial assets become dependent on policy support, tangible monetary assets begin to play a different role. Gold becomes a credibility hedge against currency debasement, while silver becomes a hybrid hedge tied both to monetary stress and industrial demand. That dual nature is precisely why silver behaves differently than gold during transitions, and why holding one without understanding the role of the other creates imbalance. One of the biggest mistakes people make is thinking in percentages without context. They hear rules of thumb like 5% in gold or 10% in precious metals and assume those numbers are universal. They are not. Allocation is not about copying a model portfolio. It is about matching exposure to risk. A person with high leverage, low savings, and income tied to the financial system needs a different allocation than someone with low debt, diversified income, and strong cash flow. Enough is relative, but it is not arbitrary. Another critical misunderstanding is time horizon. Gold and silver do not protect you from daily volatility. They protect you across cycles. People who panic, sell metals during drawdowns, are often the same people who bought them for the wrong reasons. Protection assets feel uncomfortable when you own them correctly because they are not supposed to make you feel rich during bubbles. They're supposed to make sure you are not wiped out when bubbles deflate. As we approach 0.286, several structural pressures are converging. Government refinancing needs are accelerating. Interest costs are consuming larger portions of national budgets. Political cycles are increasing pressure on central banks to support growth and employment at the expense of currency stability. At the same time, global trust in reserve currencies is being tested by sanctions, trade fragmentation, and geopolitical realignment. These are not theoretical risks. They are already visible in policy decisions and market behavior. Central banks themselves are signaling this shift through their actions rather than their words. Despite higher prices, they continue to accumulate gold, not because they expect immediate crisis, but because they are reducing exposure to counterparty risk. When institutions that issue currencies choose to hold an asset that cannot be printed, it tells you something about how they view the future. Individuals should pay attention to that signal. Silver adds another layer to this picture. Unlike gold, silver is consumed. It is used in energy infrastructure, electronics, medical applications, and defense technologies. As industrial demand grows and supply remains constrained, silver's role as both a monetary and industrial asset creates volatility, but also opportunity. However, volatility cuts both ways, which is why sizing matters even more for silver than for gold. So, how do you think about enough in practical terms? You start by defining what you're trying to protect. If your goal is to preserve purchasing power through a period of elevated inflation and currency weakness, gold tends to do that more consistently. If your goal includes optional upside from monetary stress combined with industrial scarcity, silver plays a larger role. But neither should dominate your financial life to the point where you're exposed to unnecessary volatility or liquidity risk. Liquidity is another often overlooked factor. Metals are not as liquid as cash or equities in all circumstances, especially physical metals. That is part of their strength and part of their limitation. You do not want to be forced to sell protection assets under stress to cover short-term needs. That means metals should sit on top of an emergency buffer, not replace it. People who skip this step often end up liquidating metals at the worst possible time. The 2026 question is also about sequence. The order in which events unfold matters. Inflation may come in waves, policy responses may lag, markets may swing between complacency and panic. Gold and silver tend to respond differently at different stages of this process. Gold often leads during confidence shocks, while silver tends to accelerate later when liquidity expands and inflation becomes visible. Understanding this sequence helps prevent emotional decision-making. There's also the psychological dimension. Holding metals requires conviction because there will be long periods where they appear to do nothing while other assets outperform. That is the cost of insurance. People who cannot tolerate that discomfort tend to abandon their position right before it becomes valuable. This is why enough is not just a number. It is an amount you can hold without constantly second-guessing yourself. For some people, enough might mean being able to cover a year of basic expenses if the currency weakens significantly. For others, it might mean protecting a portion of long-term savings from financial repression. There's no single answer, but there is a wrong answer, and that is assuming that minimal exposure will somehow scale when stress arrives. It will not. Another mistake is anchoring to nominal prices rather than real outcomes. People ask whether gold at a certain price is expensive without asking what that price represents, relative to currency supply, debt levels, and purchasing power. In an environment where money is being created faster than goods and services, nominal prices lose meaning. What matters is what an asset can buy over time. As we move closer to 2026, the margin for error narrows. Adjusting allocation early is easier than adjusting under pressure. That does not mean going Allen or making dramatic moves. It means being intentional rather than reactive. The people who do best in transitions are not the ones who predict perfectly, but the ones who position conservatively and stay flexible. This is also why combining gold and silver thoughtfully matters. Gold provides stability and credibility. Silver provides optionality and leverage to monetary stress. Used together, they can balance each other. Used poorly, they can amplify mistakes. The goal is not to maximize returns, but to minimize regret. In the next part, we are going to get much more specific. We will break down realistic allocation frameworks, scenario-based thinking for 2026, and the common mistakes that leave people underprotected even when they think they are prepared. Because knowing that gold and silver matter is not enough. Knowing how much and why is what actually makes the difference. Now that we have established why the question of enough matters more than simply owning some gold or silver, we need to translate that understanding into practical frameworks that people can actually use. Because without structure, preparation turns into guesswork, and guesswork is exactly what fails when stress arrives. The first thing to understand is that there is no universal allocation that magically works for everyone. But there are ranges that have historically provided meaningful protection during periods of monetary stress, inflation, and financial repression. And these ranges are based on outcomes rather than opinions. When we look back at previous monetary transitions, including the 1970s inflationary cycle, emerging market currency crisis, and periods of financial repression in developed economies, the people who preserved purchasing power were not the ones with token exposure, but those who had a meaningful percentage of their net worth in assets that were not directly tied to the financial system. For most individuals, meaningful does not mean extreme. It does not mean betting everything on metals or abandoning productive assets. What it means is allocating enough that the performance of those metals can offset losses or stagnation elsewhere. Historically, that range has often fallen between 10% and 25% of net worth in precious metals, depending on individual circumstances, debt levels, income stability, and geographic exposure. Below that range, metals tend to feel psychologically comforting but financially irrelevant. Above that range, volatility and liquidity constraints can become problematic, especially for those who rely on their portfolio for cash flow or near-term expenses. Within that broader range, the balance between gold and silver matters. Gold tends to be the anchor. It is less volatile, more liquid globally, and more directly tied to monetary credibility. Silver, by contrast, is more volatile and more sensitive to both industrial cycles and speculative flows. Because of this, gold typically plays the role of preservation. While silver plays the role of amplification, that does not mean silver is riskier in all contexts, but it does mean its swings are larger, both up and down. For many people, a gold-heavy allocation within their metals exposure provides stability, while a smaller but meaningful allocation to silver provides optional upside if monetary stress escalates. A common framework used by conservative allocators is roughly 2 or 3 gold and 1.3 silver within the precious metals portion of their portfolio. This balance has historically reduced volatility while still allowing participation in Silver S upside during periods of inflationary pressure or supply stress. More aggressive allocators might tilt closer to a 50-50 split, but that comes with the understanding that drawdowns will be sharper and patience will be tested more severely. The key is not maximizing potential returns, but aligning exposure with temperament, because the best allocation is useless if you abandon it under pressure. Another critical factor is form of ownership. Physical metals behave differently from paper representations. This distinction becomes more important as systemic stress increases. Physical gold and silver eliminate counterparty risk but introduce storage, insurance, and liquidity considerations. Paper instruments offer convenience and liquidity but rely on the stability of the financial system. Many people underestimate how these differences matter until they do. In environments where trust is eroding, the value of direct ownership becomes more apparent, but that does not mean all exposure must be physical. A layered approach, combining physical holdings with carefully chosen financial instruments, can provide balance. It is also important to think in terms of function rather than labels. Ask what role each portion of your allocation is meant to play. Is it meant to preserve purchasing power over decades? Is it meant to provide optional liquidity during crisis? Is it meant to hedge currency risk or geopolitical risk? When you answer these questions honestly, the appropriate size and structure of your metals allocation becomes clearer. Without this clarity, people often chase performance rather than protection. The 2026 timeframe adds urgency to this analysis because many of the pressures building today are cumulative rather than cyclical. Debt levels are not expected to meaningfully decline. Demographic pressures are increasing entitlement costs. Political incentives favor short-term stability over long-term discipline. These forces suggest that policy responses will continue to favor inflation and financial repression rather than austerity. In such an environment, assets that depend on policy credibility become riskier, while assets that exist outside the policy framework become more valuable as hedges. One of the most underappreciated risks heading into 2026 is the erosion of real returns. Even if nominal asset prices rise, inflation-adjusted outcomes may disappoint. This is particularly dangerous for savers who rely on traditional fixed income instruments or cash-heavy portfolios. Gold and silver do not produce yield, but they can protect purchasing power when yields are artificially suppressed. In a world where real yields remain negative or unstable, the opportunity cost of holding metals decreases, even if nominal rates appear attractive. Another scenario to consider is volatility clustering. Periods of calm often precede periods of instability, and markets tend to underestimate how quickly conditions can change. Gold and silver often respond not to gradual shifts, but to sudden realizations. This is why waiting for confirmation can be costly. By the time the need for protection is obvious, the price of protection has usually increased. Preparing gradually rather than reactively reduces both financial and emotional stress. There's also a geopolitical dimension that cannot be ignored. Fragmentation of trade, currency blocks, and payment systems increases the value of neutral reserve assets. Central banks have already responded to this reality by increasing gold holdings, not because they expect immediate collapse, but because they are reducing dependence on assets that carry political risk. Individuals face similar, though smaller scale considerations. Diversifying away from any single system reduces vulnerability. Another common mistake is treating metals as a trade rather than a position. Trading requires timing, discipline, and emotional resilience. Positioning requires patience and clarity. People who constantly adjust their metals exposure based on short-term price movements often end up with worse outcomes than those who establish a thoughtful allocation and rebalance occasionally. The goal is not to outsmart the market, but to remain solvent and flexible across a wide range of outcomes. Rebalancing itself is an important but often neglected discipline. As metals perform well relative to other assets, their share of a portfolio increases. At that point, trimming and reallocating can reduce risk without abandoning protection. Conversely, during periods when metals underperform, adding modestly can restore balance. This systematic approach removes emotion from the process and aligns behavior with long-term objectives. For those worried about starting too late, it is important to remember that preparation is not binary. Being partially prepared is better than being unprepared. The worst position is paralysis. Markets do not require perfection, only prudence. Spreading adjustments over time reduces timing risk and psychological burden. It is also worth addressing the social aspect of this topic. Discussions about gold and silver often attract extreme viewpoints, ranging from dismissal to obsession. Neither extreme is helpful. Metals are tools, not identities. They are part of a broader strategy, not a replacement for it. Keeping that perspective prevents emotional overinvestment and disappointment. As 2026 approaches, the question is not whether the financial system will function, but how it will function and who it will favor. Systems under stress tend to favor debtors, institutions, and those closest to policy livers. Savers and wage earners tend to bear the cost. Gold and silver provide a way to opt out of that dynamic to a degree, but only if held in sufficient quantity to matter. Ultimately, enough is the amount that allows you to sleep at night while remaining financially flexible. It is the amount that would meaningfully offset a decline in purchasing power without forcing you to sacrifice liquidity or opportunity. It is not a number someone else gives you. It is a range you arrive at through honest assessment of risk, goals, and temperament. The most important takeaway is this: preparation is not about predicting disaster. It is about acknowledging uncertainty. Gold and silver are not bets on collapse. They are acknowledgments of limits, limits to debt, limits to policy, limits to trust. As those limits become more visible, the role of tangible monetary assets becomes clearer. If you have been focused exclusively on silver's price movements or gold's headlines, this broader perspective is essential. The real question is not what metals will do next week or next month, but whether your financial structure is resilient enough to handle multiple scenarios without forcing reactive decisions. That is what enough really means. As we move toward 2026, the people who do best will not be the ones who guessed perfectly, but the ones who positioned thoughtfully, sized appropriately, and stayed disciplined. Gold and silver are tools for that discipline, not shortcuts. Used wisely, they can provide stability in an unstable world. Used carelessly, they can become another source of stress. The window to think clearly is always before urgency takes over. That window is still open, but it does not stay open forever. Preparing while conditions are relatively calm is far easier than scrambling when they are not. The goal is not to be alarmist, but to be realistic.